All right, before we jump in, we have to get the legal stuff out of the way. Just so we're all clear, this is not financial advice. Everything we're about to go through is for educational purposes only. You have to remember, silver and especially mining stocks, they are incredibly volatile. So please always do your own homework and talk to a licensed financial advisor before you even think about making an investment decision. Okay, with that said, let's explore a fascinating future scenario for the silver market. I want you to imagine it's January 30th, 2026, a day that could send a massive shockwave through the entire financial system. We are going to break down this hypothetical event piece by piece, look at why it could happen, and what it would mean for the future of this absolutely critical metal. So, in our scenario, this is the number that just explodes across every trading screen on the planet. A single-day collapse, 31.37% in silver futures. Now, to give you some perspective, that would be the biggest one-day drop since the Hunt Brothers corner blew up back in 1980. The headlines would be screaming, "Silver collapses." The mainstream media, they'd be tripping over themselves to declare the bull market dead and buried. But they'd be missing the real story, the actual story. Because this is where it gets really, really interesting. This slide shows the incredible divergence that would be happening under the surface. You see, in this scenario, while the New York paper contracts are in an absolute freefall, something totally different is happening in the physical market. In Shanghai, where they trade actual physical bars of silver, the price could be trading at a massive premium. We're talking maybe over $20 higher than the paper price in the West. This wouldn't be a crash in silver. No way. It would be a crash in a type of silver. And that distinction, well, that's everything. So to really understand this kind of disconnect, this complete break in the market, we have to look at what could actually trigger such a massive sell-off. And the crucial thing to understand here is that this would be an event pretty much entirely contained within the highly leveraged, cash-settled paper markets of the West. The catalyst? It could be anything, really. Let's say the nomination of a well-known monetary hawk to be the next chair of the Federal Reserve. Something that just sends a shockwave through markets that were all positioned for easy money and rate cuts. But look at the difference here. Gold might drop, over 11%? That's a huge move. But silver? Silver could fall 3 times harder. And why is that? It's because the paper market for silver is just so much more leveraged, so much more speculative. This would be a violent, brutal unwinding of paper bets. It would have almost nothing to do with physical reality. An event like this wouldn't just happen in a vacuum, though. It would really be the explosive finale to a problem that's been festering for years and years in the precious metals world. This massive, and I mean massive, disconnect between the paper claims on silver and the actual metal sitting in the vaults. And to get our heads around this, we have to talk about a really key concept, the paper-to-physical ratio. And it's simple, really. It's just the number of digital or paper ounces that have been sold for every 1 single ounce of real physical silver that actually exists in the exchange warehouses. Leading into a crisis like the one we're imagining, that ratio could hit an absolutely astonishing 356 to 1. I mean, just stop and think about that for a second. For every single ounce of silver, there could be 356 different claims on it. The entire system, the whole shebang, is built on the belief that almost nobody will ever ask for the actual metal. It's a game of musical chairs with 1 chair and 356 players. But in our January 2026 scenario, the music would just stop. Cold. Imagine, in just 1 week, big institutional players finally call the bluff. They stand for delivery and they pull 33.45 million ounces of physical silver right out of the COMEX warehouses. That's 26% of the entire registered inventory. Gone. In a flash. The physical run would be on, and the paper market wouldn't be able to hide its nakedness any longer. Okay, but why would the price split so violently between the East and the West? I mean, what would stop traders from just buying the cheap metal in New York and shipping it over to Shanghai to make a quick buck and close that gap? The answer could lie in a fundamental, game-changing policy shift from the world's largest consumer of pretty much everything. So picture this. What if, effective January 1st, 2026, China were to suddenly designate silver a dual-use strategic material? Now, that wouldn't just be some fancy title. It would come with real teeth. They could mandate strict licensing for anyone who wants to move it. They could slash their export quotas by 40%. They could set minimum price floors for any silver leaving the country and flat-out ban shipments if the Western price was trading too low. In effect, they would build a fortress around their domestic silver supply, a great silver wall. And this quote just perfectly captures the consequence. The old arbitrage loop, the game that kept global prices in line, would be broken, smashed. Silver would effectively become trapped inside China, creating a localized but incredibly severe scarcity in the West. Price discovery would no longer be set by algorithms and bankers trading paper in New York. It would be set by industrial end users, the builders in Shanghai who actually need the physical metal. The center of gravity for the entire silver market would have shifted east. Now, let's pivot for a second away from all market mechanics and back to physical reality. Because what a paper market meltdown, like the one we've described, would completely and totally ignore is that modern industrial demand for silver, it isn't based on speculation. It's based on physics. Silver is the most electrically conductive element on the entire planet, period. There is simply no substitute for it in a lot of these high-performance applications. I mean, just look at this breakdown. The solar industry is on track to gobble up over 120 million ounces in 2026 alone. The whole AI revolution with its massive power-hungry data centers, it runs on silver. And every single electric vehicle uses up to double the silver of a traditional car. This is an optional demand you can just wish away. It is absolutely essential. So you've got this insatiable, non-negotiable demand, and it's slamming right into a wall of inelastic supply. Global mine production actually peaked way back in 2016 and has been falling ever since. And here's the kicker. Because about 70% of all silver is just a byproduct of mining other metals like copper and zinc, you can't just flip a switch and turn on a silver spigot when the price goes up. It doesn't work that way. We are locked into a structural supply deficit, and there is no quick fix. And all of this, it brings us to the most fascinating part of the entire story, the investment implication. A violent paper market crash like the one we've imagined could create one of the greatest dislocations, one of the biggest opportunities we've ever seen between the price of the metal itself and the value of the companies that actually pull it out of the ground. Right now, a lot of the best-in-class silver miners are trading at just 0.66 times their net asset value. Now, what on earth does that mean? It's simple. It's like buying a portfolio of proven in-the-ground silver reserves for just 66 cents on the dollar. The market has completely, utterly mispriced these assets relative to the very metal they produce. And their potential profitability is just staggering. I mean, let's take a company like Pan American Silver, for example. Their all-in sustaining cost, that's their AISC, is guided to be somewhere between, say, $16 and $18 an ounce. Now, at a hypothetical future price of, let's just say, $80 silver, that's nearly a 75% profit margin. Those are numbers you usually see in high-flying software companies, not in capital-intensive mining operations. This is the coiled spring. So, if a scenario like this were to actually unfold, how would an investor even begin to navigate it? It would be a messy, volatile market, and that requires sharp tools to separate the high-quality operators from all the junk. And you'd have to track the data in real time. You know, this is exactly the kind of complex environment we built our research platform, MineStock Pro, to analyze. I mean, to make sense of this, you'd need to be tracking dozens of companies at once. You'd want to be able to instantly compare producer costs to see who has the best margins in a rising price environment. You'd need to translate complex geology reports into simple ratings. The goal is always to have the right data right at your fingertips to make informed decisions. Okay, let's bring this all home. What is the key takeaway from our hypothetical silver reset of 2026? What's the bottom line? Well, the crucial thing to understand from this thought experiment is this. A crash like the one we imagined on January 30th wouldn't necessarily be the end of the silver bull market. In fact, it could be a violent but necessary clearing of all that speculative excess. It would be the paper market's last gasp before being totally overwhelmed by physical reality. A crash like that wouldn't find a single new ounce of silver. It would only expose just how scarce the real metal truly is. The scarcity is real. The industrial demand is permanent and it's growing. Nations like China may be looking to hoard these strategic assets. The West is literally draining its vaults. And meanwhile, the mining stocks are trading at historic discounts while being poised to generate incredible cash flow. You see, the floor has been set by physical demand, not by paper games. The spring is coiled. The only question left is, are you positioned for what's coming? And just one final reminder, this has been for educational purposes only. It is absolutely not financial advice. Mining stocks and precious metals carry significant risk, and that includes the total loss of your capital. Please do your own thorough research, consult a licensed professional, and only invest what you can truly afford to lose. Thanks for tuning in.